Hey guys, welcome back to another video. My name is Kimothy, and on this channel we speak everything personal finance. In today's video, we're going to be talking about some places that you can store your money as interest rates drop. So by storing your money into these accounts, this will help better improve your financial situation, even with the drop of interest rates. So first is your high yield savings account. So even with falling interest rates, high yield savings accounts still offer you more yield than a traditional savings account. There are still a lot of high yield savings accounts out there that are giving you 4+% return on your money. Note you hear when interest rates fall, that's when the rates for these high yield savings accounts fall as well, which is true. But like I said, there are so many institutions and so many banks out there that are still offering you a great return when it comes to these high yield savings accounts. For two quick examples, Ally Bank is giving me a 4% return on my money with their high yield savings account, and Marcus by Goldman Sachs is giving a 4.1% return on their high yield savings account. So there's still companies out there, there's still banks out there that are giving these great returns even though interest rates are falling. So don't overlook a high yield savings account, and don't think that you need to start moving your money out of your high yield savings account right now. The money that you should be putting and that can still go into these high yield savings accounts is money that's going towards your emergency fund or really any short-term saving goals like saving for a car or saving for a house. You still want to make sure that your main savings account is a high yield savings account, because you're going to be getting way more return on your money than you would with a traditional one. But be aware, as the Fed starts to cut rates, the rates on these high yield savings accounts will drop. So just find a new high yield savings account or just stick with the same one you have. You really don't want to put too much energy and focus on rate shopping, especially when we're talking about something between a 4% and a 3.8%. It's really the same. So stick with your high yield savings account, especially for short-term goals. So then we have certificates of deposits, which are CDs. So be sure that if you are putting your money into CDs, that they're FDIC insured, protecting up to $250,000. So if the bank fails, your money is still safe, up to $250,000. So with CDs, you can lock in rates before they drop. So CDs drop just like high yield savings account interest rates drop, but you can lock in these rates. So if you go to Ally Bank, they'll say, if you put your money into this CD account for a year, then we'll lock you in at a 4.5% interest rate. On that account, the money's going to grow at a 4.5% interest rate. No matter what happens, no matter if it lowers after the fact, it doesn't matter. That money is locked in at whatever rate they gave you. And a lot of times the CDs have a higher interest rate than the high yield savings account, and this is because you're locking your money in for a longer period of time. The amount of time that you lock your money in for a CD can range from 3 to 6 months to a year to 2 years. I've seen some at 5 years. So you can really lock your money in at a good interest rate with your CDs. Then you can do that, but that's more for long-term saving goals. So say maybe you're saving for a down payment on a house, you can lock in that interest rate with your CD. And honestly, the best thing about CDs is that they offer you a predictable return. So if you lock in a 4 or 5% with a CD, you know that you're gonna get 4 or 5% back on your money. It's not gonna go down. It's not subject to volatility because you're locked in at that rate no matter what. So CDs are a great option. Still, even with interest rates going down, if you are going to do a CD, you might want to lock it in sooner than later. Of course, that's up to you, but they're saying the interest rates are going to go down, and as interest rates continue to go down, these CDs interest rates will go down as well. So still in 2024, you can start locking in some good rates. Another great place to put your money is into treasury bills. Now, treasury bills are backed by the US government, and often they're exempt from state and local taxes. Now, treasury bills are similar to CDs in the fact that you're locking in rates for a certain amount of time. So you might get a locked in rate for a treasury bill at 5%, and just be aware that when that date matures, you want to be sure to see what the rates are at the moment, so you're not locking in a lower rate when you don't have to. And one of the best things about treasury bills is the liquidity. Treasury bills are easy to buy and easy to sell, so if you need quick access to your money, you can get that out of a treasury bill. Another thing you can do is refinance your mortgage. So as the interest rates drop, that means the mortgage rates are going to drop. So if you have a 7% mortgage rate, the mortgage rate could drop to 6 or 5%, which could be a good time to refinance your mortgage. Even a 1% reduction in your mortgage rate can save you hundreds of dollars in a month. But just be aware when you are refinancing your loan that you will pay closing costs. And closing costs can be between 2 to 5% of your loan. So if you are planning on refinancing your home, just be sure that you're going to stay in the home long enough to recoup the cost. And one of the best places to store your money, and one of my favorite places to store my money, is into the stock market. The stock market is one of the best places that you can put your money so you can avoid the inflation on your dollars. With the average return of the S&P 500, which is a collection of the top 500 companies in the US, and that rate of return being 10%, you really can't go wrong by investing your dollars. So you can invest your money in many different ways. You can invest your money through a brokerage account, you can invest your money through a Roth IRA, you can invest your money through a 401k, and many others. A bulletproof way to store and grow your money is by investing. By investing your money, it's going to grow faster than it does in a treasury bill. By investing your money, it's going to grow faster than it does in a high yield savings account. Now, the thing that comes with investing is that there's a little more volatility, of course, depending on what you're investing in. If you're investing in something like the S&P 500, that's going to be a more clear-cut, simple way of investing. Like I said, the average return of the S&P 500 is about 10%. But if you're investing into an individual stock, then the volatility, of course, will be different than investing into the S&P 500, which is a collection of 500 companies. And if you are investing, you want to look to invest long-term. We are long-term investors because we have a long time horizon before we actually retire. So yes, there could be years when it's down. There could be years when your portfolio is down, but we are long-term investors. We're just going to keep investing that money into the stock market. We're going to keep investing that money into stocks and into companies that we believe in. So investing is truly one of the best places to store your money when it comes to these dropping interest rates, because the interest rates might drop, but that doesn't mean the portfolio is going to drop. That doesn't mean that the return on the S&P 500 is going to drop as well. So like I said, a great option is to invest your money. The last place you can store your money is into real estate. Now, real estate is not easy. It's not a cakewalk. It takes a lot of money to buy real estate. It takes a lot of money to manage real estate, but real estate is a great place to store your money. You can almost look at real estate as a savings account, because eventually if you do move, if you ever pull that money out, it has more than likely grown. That's kind of how I look at our rental property that we have. It's a little house that we have down the street, and the down payment was about $20,000. As home values increase, that means the property that we purchase will increase. You can look at real estate as a good option for a place to put your money. And as these interest rates begin to drop, this is the perfect time to start looking into real estate, because interest rates really make a difference. You would be surprised how much money you're going to be saving by paying less in interest on these homes. So these interest rates dropping is a great thing for real estate, because you can purchase houses for cheaper because the interest rates are dropped. So instead of paying a 7% interest rate on a home, you would now be paying maybe a 6 or 5% interest rate. Who knows what the interest are going to drop down to, but this is just another option for you to park your money as the Fed starts lowering rates. And another great thing about rentals is that they generate passive income. They generate monthly income that maybe is not so passive, because there are some things you have to do. It's a lot less hands-on than generating money from your job. And then as that property appreciates over time, you still continue to collect that cash flow, and then you can raise rents, and then you get more cash flow. So rentals are really good, especially if you can get into them. Like I said, buying a house is not easy. I might make it sound easy, but it's not. It's a lot that goes into it. So just be sure that before you go in, become a landlord, it's something that you really, really want to do. And that's it. Those are some places that you can park your money as the Fed begins to lower rates. I hope you guys enjoyed this video. And if you did, leave a like and subscribe to my channel, and I'll see you guys in the next video.